Chapter 8.2, Income Tax. Income tax is a percentage of your income collected by the government to fund its services and programs. The federal government collects income tax, and most, but not all, state governments do too. Tax revenue pays for our national defense, fire and police protection, road construction, schools, libraries, and parks. Without taxes, the government would not be able to conduct medical research, provide medical care for the elderly, or send astronauts into space. Calculating your federal income tax begins with gross income, or total income for the year. This includes income from wages, tips, interest and dividends, unemployment compensation, profits from a business, rental income, even game show winnings. And it does not matter if these winnings are in cash or in prizes. Okay, the next step in calculating your federal income tax is to determine your adjusted gross income. Adjusted gross income is figured by taking gross income and subtracting certain allowable amounts called adjustments. These untaxed portions of gross income include contributions to certain retirement accounts and tax-deferred savings plans, interest paid on student loans, and alimony payments. IRS rules detail exactly what can be subtracted from gross income to determine your adjusted gross income, and you'll be told in the problems in this section if you have an adjustment or not. So, adjusted gross income is your gross income minus your adjustments. Now, you're entitled to certain exemptions and deductions subtracted from your gross income before calculating your taxes. An exemption is a fixed amount on your return for each person supported by your income. A standard deduction is a lump sum amount that you can subtract from your adjusted gross income. Okay? Most young people take the standard deduction because their financial situations are relatively simple and they're not eligible for numerous deductions associated with owning a home or making charitable contributions. As a matter of fact, I think most people take the standard deduction. You have to have quite a bit of itemized deductions before that's a better deal for you than the standard deduction. Itemized deductions are deductions you list separately if you have incurred a large number of deductible expenses. Itemized deductions include interest on home mortgages, state income taxes, property taxes, charitable contributions, and medical expenses if they exceed 7.5% of your adjusted gross income. Taxpayers should choose the greater of a standard deduction or an itemized deduction. So, your taxable income is your adjusted gross income minus your exemptions and deductions. A tax table is used to determine how much you owe based on your taxable income. However, you do not have to pay this much tax if you're entitled to any tax credits. Tax credits are sums of money that reduce the income tax owed by the full dollar-for-dollar amount of credits. A tax credit is not the same thing as a tax deduction. A tax deduction reduces taxable income, saving only a percentage of the deduction in taxes. But a tax credit reduces the income tax owed on the full dollar amount of the credit. There are credits available for everything, from donating a kidney to buying an energy-efficient dishwasher. The American Opportunity Credit, which was included in the economic stimulus package of 2009, provides a tax credit of up to $2,500 per student. The credit can be used to lower the cost of your first 4 years of college. You can claim the credit for up to 100% of the first $2,000 in qualified college costs and 25% of the next $2,000. So make sure you keep that in mind when you're doing your taxes. Make sure that you check on that tax credit. Credits are huge. Most people pay part of all of their tax bill during the year. If you're employed, your employer deducts federal taxes through withholdings based on a percentage of your gross pay. When you file your tax return, all you're doing is settling up with the IRS over the amount of taxes you paid during the year versus the federal income tax you owe. Many people will have paid more during the year than they owe, in which case they receive a tax refund. Others will not have paid enough and need to send the rest to the IRS by the deadline. So this table shows the 2012 tax rates, standard deductions, and exemptions for the 4 filing status categories. So let's see what our status categories are, filing status categories. We've got single, married filing separately, married filing jointly, head of household. You know, taxes are one of those things that really the average person just doesn't understand. And a lot of that is, I think our politicians use this idea of paying taxes to further their cause, and they're just hoping that we don't understand enough about it so that we believe what they're saying. But just because if I'm in the 25% tax bracket, that does not mean I pay 25% of my earnings in taxes, not even close. Now, the way this table works is everyone, right, whether you're single, married filing separately, notice married filing jointly, notice 8,700 plus 8,700 is 17,400. So everyone, you, me, the president of the college, the president of the country, pays 10% of their first $8,700 in taxes, except head of household. They get a little bit of a break. They have $12,400 that they can make at the 10% rate. Now, after we've paid 10% on our first $8,700, then the next chunk, right, and depending on your status, what that chunk falls in, but let's say from $8,700 to about $35,000, you pay 15% on that chunk. If you made more than $35,000, the next chunk, again, it's different depending on your category, but just to get an idea of the way the table's going to work, over $35,000 up to $71,000, you pay 25% on. So let's say if I made $50,000, I only pay 25% of that last $15,000. Actually, that would be if my $50,000 was taxable income, but if my salary is $50,000, then I get to take off my adjustments, I get to take off my deductions, I get to take off my exemptions, so that I would probably be left with something in the upper 30s to low 40s, so I'd only pay 25% on a few $1,000s, right? But if I made a couple of $100,000, then I'd pay 28% on my next $30,000 and then 33% on my next chunk. Okay, here's our deductions down here. Sorry, touched it and it moved. Okay, so we get for $5,950 for the standard deduction, unless you're head of household. You get a little bit bigger break there. Head of household means that you're not married, but maybe you have children in the home that you're supporting, or some kind of dependents. Okay, so everyone gets to take at least $5,950 off of their income for deductions, and then every person in the household is to take an extra $3,800 off. So minimally, if you're just one person, single person, and let's say we made the $50,000, you get to start out by taking off, what's that, $9,750 from the $50,000. So you're just barely at $40,000 that you're really paying taxes on. It's really important to understand our taxes because it's really important to be able to base what people are saying about the taxes and make an informed decision. So let's look at a couple of problems here of how we can calculate our taxes. Let's calculate the income tax owed by a single male with no dependents, and here are his identifying marks. Okay, he has a gross income of $75,000 and he has adjustments of $4,000. Meaning the first thing I got to do is find that adjusted gross income. So his adjusted gross income is $75,000 minus $4,000. So far we're down to working with $71,000 for this guy, right? Take off those adjustments first. Now, he has a lot of deductions. This is a crazy kind of deduction. Someone making $75,000 should not owe $28,000 in mortgage interest. Can't afford that home, but okay, we'll go with it. So then the next thing you have to do, after you determine if you have any adjustments that can be deducted, is you choose your standard deduction, and this guy's single, so his standard deduction versus his itemized deductions, and you choose whichever one is larger. Well, obviously this one is larger. So if I add up all these deductions, $28,000 plus $4,200 plus $3,000, what's that, $36,200? Let me double check that just so we don't have an error here. Yeah, oh, I'm glad we double checked that. $35,200. Okay, so his deductions, he has $35,200 worth of deductions. I get to take that off of the $71,000, right? So I have $71,000. I'm going to take off his $35,200, and I get to take off his exemptions, right? Since he's single, right, no dependents, he only gets the $3,800 for himself. So $71,000 minus $35,200 minus $3,800 is $32,000. All right. Now, that's what he owes taxes on. Even though he made $75,000, he's only going to pay taxes on $32,000. So the next thing I do is I go over here and I look. This guy's in the 15% tax bracket, which again doesn't mean he's going to pay 15% of his salary. The first $8,700, everyone except the head of household only pays 10%. So the first thing I do is I say, okay, well, I've got 10% of $8,700. Right, so that's $870 that I owe for that first $8,700 that I made. Now I'm going to pay 15% on my next chunk. But I don't even have to pay for this whole category because I only have to pay from $32,000. So I'll say $32,000 minus $8,700. Right? Take off that $8,700 because I've already paid taxes on, or I've got the accounting here of what I owe for the $8,700. So I don't want to pay 10% on this money and then pay 15% on it again. So if I enter that in my calculator, 15% of $32,000 minus $8,700 is $3,495. $3,495. So here's the total taxes this guy owes. Add this up to see that we have $4,365. Now, don't forget to look for a tax credit, but this guy had no tax credit, so here's the amount of taxes that he owes. And let's see how much that is as a percent. Let's say 4365 out of 75,000 is 0.0582 or 5.8% taxes that he paid, even though he wound up in the 15% tax bracket. And even though if you look at 75,000, he'd be in the 25%. He's actually in the 15% tax bracket, but he really only paid 5.8% of his taxes. So people are really misleading about the way taxes work. Keep that in mind. Also, this one's a little misleading because these are obviously contrived figures that aren't reasonable. Let's see if the next one's a little bit better. But I usually want, and I don't have any extreme, deductions or anything in particular. We do a couple of farm deductions, but I wind up paying on average, I range from 9, 10, 11%. Not what most people think, not what it really feels like. All right, let's do another one. See if it's a little more realistic. Okay, calculate the income tax owed by an unmarried head of household with 2 dependent children and a gross income of $50,000 with no deductions. Yeah, much more reasonable. How we don't live in a state that has state taxes, but I have lived in a state with state taxes before, so this is something that's very reasonable. All right, so $50,000. So the first thing I do is find my adjusted gross income. In this case, since I don't have any adjustments, it still stays $50,000. Okay, do you remember what you do next? Yes, find your deductions and exemptions. Let's determine which deduction we want to use. If I add these two together, I get $6,500. Right? Okay, and my standard deduction for an unmarried head of household, now make sure you choose the right column, so unmarried head of household, hey, that's $8,700. I do not want to use $6,500 to take off of my taxes if I can use $8,700. So in this case, I'm just going to use the standard deduction, which, as I said, that's what most people wind up doing anyhow. And, okay, he's an unmarried head of household with 2 dependent children. He gets to take off $3,800 for him and each of his dependents. So the first thing we're going to do is take our income, subtract our standard deduction, because that's better than anything that we have itemized, and for most of us, that's always the case. And then I'm going to take off 3 3,800s. Right? So I can just say minus 3,800, minus 3,800, minus 3,800. All right, so let's see what our taxable income is. $50,000 minus 8,700 minus 3 times 3,800 gives us $29,900. $29,900 for this guy's taxable income. So if I'm looking at head of household, he's also in the 15% range. Okay, so his first $12,000, he only has to pay 10% taxes on. $12,400. Right? So that is $140 in taxes he owes so far. Now, he made more than $12,400, so he's got to pay a little more taxes. He's going to pay 15% on the next chunk. But he didn't make $47,000. So I get to use the $29,900. But I want to subtract that $12,400. I've already paid taxes on that. I don't want to pay double taxes. If I put that in my calculator, I see 29,900 minus 12,400. $2,625. And that's the taxes he's going to owe. Well, not quite. Okay, so far that's the taxes he's going to owe. But don't forget, this guy has a $2,000 tax credit. And remember, you can get tax credit for all kinds of things. Look and see if you're entitled to any tax credits, because they're way more, they affect your taxes a lot more than a tax deduction. So in reality, this guy's going to pay $1,865 for his taxes. And now let's go back and look at this one right here. Okay, unmarried person with 2 children making about $50,000 a year, and this is standard everything. So let's see what percent of their income they actually pay in taxes. And I mean, that's if they don't have any kind of extra considerations that they can use. That is 0.0773 or 7.73%, right? With nothing extra, using everything standard. Then this $50,000 tax earner really pays about 7.75%, less than 8% in taxes, less than what he pays in sales tax to purchase products for income tax. Okay, I think this is the last sample, but since we didn't go to anything above the 15%, just so you can see how that works, let's adjust this a little bit and see what we would do for the next step. All right. So let's suppose instead of $29,900, let's suppose this person made $125,000 that he is paying taxes on, right? $125,000 of taxable income. All right. The first step's exactly the same. The first step is exactly the same. He pays 10% of $12,400. Then he's going to pay 15% all the way up to $47,350. So $47,350. But I don't want to pay extra money on the 12%. On the $1,200. So let's see what this is. 15% of $47,350 minus $12,400. Okay, $52,4250. Okay, so then, but he made more than $47,350, so he's got to pay taxes on that next amount, and he's got to pay 25% on his next chunk of money. So we'd say 25% of, and because he even made more than $122,000, we'll take the $122,300, and we'll subtract $47,350. Because he's already paid taxes on his $47,350. Plug that in the calculator. Excuse me. Stop me to drink, guys. Okay. So that is $18,737.50. And then he even made more than $122,000. So he's got to pay 28% of his next batch, but now he only made $125,000. So let's do $125,000 minus the $122,300. Notice he's only got to pay 28% there of a couple $1,000. So $756. And if we add all of those up, this guy owes $25,976. $25,976 in taxes. Okay, let's see what percent that is. For someone with a taxable income, well, really we can't see what percent that is because we don't know his original income. Remember, he's got already taken off many thousands of dollars off of that. So I can't do the percent of his actual income. Percent of his taxable income, though, is 20.1%. So even though that sounds like a lot of taxes that this guy owed, about $26,000, remember he's making well over $125,000. He's paying well under 20%. Okay, so some food for thought there. Go practice that. Let me know if you have any questions.